please elaborate your views on risk? You clearly aren't a fan of relying on statistical probabilities, and you highlight the need for $20 billion in cash to feel comfortable. Why is that the magic number, and has it changed over time?
Yeah, well, it isn't the magic number, there is no magic number. I would get very worried about somebody that walked in every morning and told us precisely how many dollars of cash we needed to be, secure to 3 sigma or something like that. Charlie and I have had we saw a lot of problems develop in an organization that expressed their risks in sigma. We even argued sometimes with the appropriateness of how they calculated their risk. And
it was truly horrible.
Yeah, and they were a lot smarter than we were. That's what was depressing. But we both have the same bent of mind, whereby we think about worst cases all the time, and then we add on a big margin of safety, and we don't want to go back to go. I mean, I enjoy tossing those papers in the other room, but I don't want to do it for a living again. So we undoubtedly build in layers of safety that others might regard as foolish. But we've got 600,000 shareholders, and we've got members of my family that have 80 or 90% of their net worth in the company, and I'm just not interested in explaining to them that we went broke because there was a 1/100th of 1% chance that we would go broke, and there was the remaining probability was filled by the chance of doubling our money. And I decided that was just a good gamble to take. We're not going to do that. It doesn't mean that much. We are never going to risk what we have and need for what we don't have and don't need. We'll still find things to do where we can make money, but we don't have to stretch to do it. And it's my job, and Charlie thinks the same way. I mean, we don't have to talk about it much, but it's our job to figure out what can really go wrong with this place. And we've seen September 11th, and we've seen September of 2008, and we'll see other things of a different nature but similar impact in the future. And we not only want to sleep well of those nights, we want to be thinking about things to do with some excess money we might have around. So it is, if you're calibrating it in some mathematical way, I would say it's really dangerous. I could give you a couple of examples on that, but unfortunately I've learned about them on a confidential basis. But some really great organizations have had dozens of people with advanced mathematical training and thinking about it daily, making computations, and they don't really get at the problem. So it's at the top of the mind always around Berkshire, and your returns in 99 years out of 100 will probably be penalized by us being excessively conservative, and 1 year out of 100 will survive when some other people won't. Charlie?
Yeah, but how do these super smart people with all these degrees in higher mathematics end up doing these dumb things? I think it's explainable by the old proverb that to a man with a hammer, every problem looks pretty much like a nail. They've learned these techniques, and they just twist the problem so they fit the solution, which is not the way to do it.
And they have a lack of understanding of history, I would say. That one of the things in 1962, when I set up our office at Kiewit Plaza, where we still are, it's a different floor, I put 7 items on the wall. Our art budget was $7, and I went down to the library, and for $1 each I made photocopies of the pages from financial history. And one of those cases, for example, was in May of 1901, when the Northern Pacific Corner occurred. And it's kind of interesting in terms of being in Omaha, because Harriman was trying to get control of the Northern Pacific, and James J. Hill was trying to get control of the Northern Pacific, and unbeknownst to each other, they both bought more than 50% of the stock. Now, when two people buy more than 50% of the stock each, and they both really want it, they're not just going to resell it. Interesting things happen.
To the shorts.
And in that paper of May 1901, the whole rest of the market was totally collapsing because Northern Pacific went from $170 a share to $1,000 a share in one day, trading for cash because the shorts needed it. And there was a little item at the top of that paper, which we still have at the office, where a brewer in Troy, New York, committed suicide by diving into a vat of hot beer because he'd gotten a margin call. And to me, the lesson, that fellow probably understood sigmas and everything and knew how impossible it was that in one day a stock could go from 170 to 1,000 and cause margin calls on everything else. And he ended up in a vat of hot beer, and I've never wanted to end up in a vat of hot beer. So those 7 days that I put up on the wall, life in financial markets has got no relation to sigmas. I mean, if everybody that operated in financial markets had never had any concept of standard errors and so on, they would be a lot better off. Don't you think so, Charlie?
Well, sure.
Here, have some fudge.
It's created a lot of false confidence. And now it has gone away. Again, as I said earlier, the business schools have improved. So has risk control on Wall Street. They now have taken the Gaussian curve and they've just changed its shape.
Away.
They threw it away. Well, they just made a different shape than Gauss did. And it's a better curve now, even though it's less precise.
They talk about fat tails, but they still don't know how fat to make them.
Right.
They have no idea.
Well, but they knew that they've learned through painful
learned
experience.
the
They
other
weren't
was
fat enough.
Yeah, they learned the other was wrong.
Yeah.
But they don't know what's right.
But we always knew that there were fat tails. Warren and I at the Solomon meetings would look over at one another and roll our eyes when the risk control people were talking.